Hello, and welcome to the latest economic and industry update, once again brought to you by Greenbrier's marketing team. I'm Mallory Moran, and I'm joined by Jay Carter. Since our last video, a lot has happened within the economy, particularly within the banking sector, leading to increased uncertainty. We'll digest a bit of that, along with broader economy and industry-specific trends. Real gross domestic product, known as GDP, is one of the broadest economic metrics, reporting how many goods and services a country produces. Jay, will you please update us on the US GDP for the first quarter and the forecast for the rest of the year?
Absolutely, Mallory, and I'm happy to join you once again to provide an economic update. So the US GDP increased by 1.1% in the first quarter, which is down from about 2.6% in the prior quarter. Now, if you'll remember, the forecast was roughly 2% for 2023. So this figure indicates an economic slowdown. However, consumer resilience has remained high, and it's expected that people will use excess savings to support spending, making the slowdown short and or shallow. Now, the GDP is expected to grow around 1% in 2023 and 0.6% in 2024. I do want to emphasize caution for the second half of this year due to recent fragility within the banking sector.
Thanks, Jay. Before we move on to the industry metrics, I'd like us to first talk about inflation and interest rates. Now, headline inflation rose 4.9% in April, down about half from the 9% peak we saw last June. Now, core inflation, which excludes food and energy, was up 5.5% in April, slightly down from March. Now, we're seeing a core inflation decelerate at a slower, albeit steady pace from last September. Jay, what are you seeing regarding interest rates?
Well, the Federal Reserve met in May and raised key interest rates by another 25 basis points, which translate to a range of about 5 to 5.25%. Now, this is the highest interest rate in 17 years and the 10th straight rate hike. However, the Fed signaled a possible pause in hikes due to a tight business cycle and a weak banking sector, as I mentioned earlier.
Thanks, Jay. Now we're going to transition right to the rail industry because since we have a lot to cover. Recently, the industry reported first quarter railcar orders, deliveries, and backlog. Roughly 8,300 railcars were ordered, down about 3,000 units from the previous quarter. Deliveries were down about 1,000, with just over 11,000 reported. And the industry backlog continued to shrink some, now totaling about 56,000 units. While the reported figures are less than what we saw for the fourth quarter last year, these are still strong numbers and in line with what we saw during last year's first quarter. Remember, these figures are very cyclical. So Jay, help us put these industry numbers into context. How are railcar loadings?
Railcar loadings are averaging roughly 3% above last year. Automotive continues to be the loadings leader. Intermodal, on the other hand, continues to be low as consumer-related freight, of course with the exception of automotive, is being weighed down by higher interest rates. Inventory destocking has also been a headwind. I will say, though, that there has been some slight improvement in both total intermodal and import volumes over the past few weeks. Now, the overall outlook for railcar loadings demand is that we expect solid demand for automotive, grain, and boxcars in the coming months. And in the second half of 2023, we also expect intermodal to improve slightly, but overall this year, 2023, will be a rough year for intermodal.
The flip side of railcar loadings is velocity, and it has remained steady through April, above 4%. Now, this is a significant increase from the low figures we were seeing last year. Jay, how does dwell time figure into this?
Year-to-date terminal dwell time has steadily increased this year, up roughly 1 hour since January through May. I suspect dwell times will continue increasing due to an industry-wide emphasis on safety and the still relatively low Class 1 crew employment levels.
The railcar builder backlogs continue to be varied between railcar types, but it's important to monitor how many railcars are in storage and are being scrapped. Jay, what are you currently seeing regarding storage and scrap rates?
So the total number of rail cars in storage has fallen slightly to about 289,000 units, representing almost 18% of the total fleet. The monthly change in the outage fleet was virtually flat, with about 1,000 sand cars being pulled out of storage as some units get repurposed into other services, while others meet a slight uptick in sand drilling demand. Of the nearly 4,000 rail cars scrapped during April, most were grain covered hoppers and large general purpose tank cars.
FTR Associates forecasts that about 45,000 rail cars will be delivered this year, with freight cars continuing to dominate the delivery mix. Any final thoughts, Jay?
Yes, the U.S. economy continues to unwind from the pandemic era fiscal stimulus. Given the recent volatility within the banking sector, the U.S. economy should experience some gridlock in the second half of this year. With all that being said, we still expect overall economic growth in 2023.
Thanks, Jay. And thank you for joining us. We hope you'll find this video valuable. Be sure to check out next quarter's edition.